Lam Research, supplier of wafer fabrication equipment and services to the semi industry. So it's one of those semi equipment makers. All right, net income in line with industry average at 27%. Has been appreciating, overall very pleasing performance. Costs have been increasing significantly, but has not resulted in a depreciation of margins. That is a strong indicator that costs are justified in achieving returns for the top and the bottom line. Very good. R&D as a percentage of revenue only slightly below the industry average. Industry average is 13%. The average for Lam Research is 12%, so only slightly, so not worrying considering the solid performance of the margins, mainly due to the rising revenue, as well as a clear indication that costs are being incurred with the ultimate intention and realization of achieving returns. So costs are basically justified. I just said a bunch of nonsense, but basically costs are being incurred and are resulting in a realization of returns in the form of growing revenue and growing net income. So good performance, revenue has been growing at an accelerated rate, which has, improved margins significantly as well as improved net income also significantly. Return on equity is very impressive because it's above the industry average of 53%. A good indication that Lam Research has effective procedures in place to realize above industry returns from operations on which capital is invested. The financial position. Now, the current ratio is well above the industry average. Strong performance in this metric. There has been a deterioration, but nothing too extreme. The same applies with the asset test ratio. Strong performance above industry average of 2.1. So both these ratios highlight a strong liquidity position that Lam Research finds itself in. Since the performance is above industry, this highlights a very attractive balance sheet that has very little liquidity risk. Inventory days are below the industry average. Industry average is about just over 160 days. Highlights that Lam does not keep inventory for longer than needed. Low inventory risk in the form of inventory obsolescence and high high holding costs eating into margins and a very low liquidity risk. So that is what this low inventory level suggests. You will see in 2021 it's at 125, but overall, even looking at 2021, the industry average is still 160 days. So overall, good performance. Looking at my asset test, current ratio as well as my inventory days, very attractive balance sheet from a liquidity point of view with very low liquidity risk. The debt to equity is below the industry average of 171%. Again, it's normal for these entities to have high debt levels, but you don't want it to be so extreme that it's above the industry norm. So the fact that the debt to equity is at 161 below the industry norm, that's very good. That indicates that the balance sheet is not that risky from a financial risk point of view. It has very low financial risk. So good, solid, attractive, low risk balance sheet. We look at the relationship between risk, debt, and return. There's a productive relationship there. So overall, very good performance. The cash position. The cash margin is pleasing, in line with the industry average of 26%. They have declined from 2019, but still stable and has recovered in 2021. So good performance there, very, very good performance there. The cash margin highlights Lamb's ability to make cash operations. The sufficiency of cash flow slightly underperformed the industry average of 0.66, but ultimately satisfied, not significantly underperforming the industry average. Most cash that Lam generates does go into rewarding shareholders. Very common in this industry that entities in this industry, we don't like holding on to too much cash on the balance sheet. We prefer to reward shareholders. Yeah. So from the cash positions that Lam finds itself in, the solid one. It's a, it's a pleasing one. It's a really, really pleasing one. All right. The returns that it provides, provides a lot of returns, as we said. They really, these companies we don't like holding on to too much cash. The PE relatively cheap, very, very, very cheap company. I mean, at 21, just over 21, very cheap PE. Um, Good company overall, performing relatively well. Yeah, but you know, I just think I could put my money elsewhere. I think I could earn a better return. So, but I mean, it is a very good company. I think even if one puts their money in Lamb, it's still a good investment. But given uh, I think other companies, I'd rather put my capital somewhere else. But still, overall, very very good company. No no complaints there.